Hey guys, what is going on? Welcome back to the portfolio. As always, want to start off the video by saying thank you to all the subscribers, all the viewers, all of the supporters on the channel. Immensely appreciate the support. For today's video, I'd like to quickly talk about capital gains tax rates. I've been referring to capital gains tax rates in a number of prior videos, and there's been a few comments in the comment threads wanting to discuss a little bit about what I mean by capital gains, as well as why is it important to take these into consideration when making trades. So I thought I'd quickly go through, define what a capital gain is, and then talk about the tremendous advantages of long-term versus short-term capital gains tax rates. So very briefly here, what is a capital gain? Well, capital gain refers to profit that results from a sale of a capital asset. That can be a stock, bond, real estate, whatever that may be, where the sale price exceeds the purchase price. Simply, you buy low, you sell high. That difference is the capital gain. Essentially, the gain on whatever asset you're dealing with. On the stock market, the buying and selling of stocks, essentially it will be a cash difference between the price which you bought a stock for and the price which you sold the stock off for. So, for example, if you buy a stock for $100, sell it off for $150, you made a capital gain of $50. It also works in reverse. You can have a capital loss, which is essentially identical to a capital gain, only in the negative. So you'd buy the stock for $150, sell it for $100, and you'd have a negative 50 capital loss there. So very, very easy to understand, but all gains need to be essentially accounted for with regards to taxes. And we'll kind of talk about the different tax rates, but every dollar you make on the stock market is going to be subject to tax at the end of the year. And you have to tally up all of your gains and then submit those to the IRS for tax rates. And we'll talk again about the different tax rates between a short-term and a long-term capital gain. And then the gain, as I just want to emphasize here, is the difference between a higher selling price and a lower purchase price. Again, buying low, selling high, capital gain. Vice versa, if you buy high and sell low and get basically out of a bad trade and have a loss, that's a capital loss. And those can be used to offset any capital gains. So if you have a few trades where you made $100, a few trades where you lost $50, your total capital gain at the end of the year will only be $50. You take your capital gains minus your capital losses, and you essentially will come up with a difference there. And whatever that difference is, if it's in the positive, you'll have to pay taxes on. So let's kind of talk about the different tax rates here. So tax rates are essentially based off your income tax for whatever filing tax year you are talking about. So you can take your ordinary income tax rate there, and you can see here there's a number of different brackets here from 10% all the way up to 39.6%. And essentially it is based off your ordinary income. So if you make less than $9,075, you're essentially in the 10% tax bracket there. Then 9,000 to 36,000, 36 to 89, so on and so forth. You'll be put into different tax brackets. And if your ordinary income tax bracket, for example, falls in the 36,900 to 89,350, you have to pay tax on all income of 25%. And the same would be true for a short-term capital gains tax rate. So if you made $100 and you fall into the ordinary income tax bracket for 25%, you have to pay $25 of that capital gain back to the government in the form of a tax. That is the short-term capital gains tax rate. If for another bracket, if you fall in the 405,100 to 406,750 and up, you're essentially paying 35%. And then if you fall in the more than 406,750, you are going to be paying the 39.6% tax bracket. Again, these are changing a bit for 2018. And I don't know if this is completely accurate, to be quite honest, for that 35% tax rate there. It's a very, very narrow window there, 405,100 to 406,750. But essentially, you're going to be saving quite a bit of money if you can qualify for long-term capital gains tax rates. And it's very, very easy how you can do that. You simply have to hold an asset for greater than 1 year between the buy and the sell point. So if you buy a stock today, you have to wait 1 year at least from today to sell it off. And if you do, qualify for a different tax bracket on the right there. So for example, if we go back to the example of the 25% tax bracket, so instead of paying $25 for every $100 back to the government for that capital gain tax rate, you're going to be paying $15 back. So you make essentially a gain of 10%, an opportunity there. Instead of paying instead of paying $25, you pay $15. You made $10. You made 10% with nothing more than holding an asset for greater than 1 year. And again, referring back to the stock market, you simply have to hold your stock for 1 year or longer before you sell off, and you have essentially a 10% gain there automatically. And it works for every tax bracket there. So if you fall into the 10 or 15% ordinary income tax bracket, and you can qualify your stock, buy and sell for the long-term capital gain tax rates, you can see there you can save 10 or 15%. So you're essentially making an automatic 10 or 15% return on money, which is tremendous. Again, if you fall in the 25%, 28%, 33 or 35% tax bracket, you're only going to be paying 15%. So if you fall in the 25% tax bracket, you're saving essentially 10%. But if you fall into that 35% tax bracket, you're going to be saving a whopping 20%. So you're essentially making an automatic 20% gain at the end of the year. The same holds true for the higher earners there, greater than $406,750. Instead of paying essentially 40%, you're going to be paying 20%. Again, automatically making 20% at the end of the year. So that's why it's so advantageous to hold the stock for the long term. That's why a lot of investors are buy and hold investors. If you can hold for greater than 1 year, you can see you can make an automatic 10 to 20% automatic return on money with doing nothing. Again, if you're doing day and swing trading, you're going to be having higher frequency trades there, so you can essentially make up that difference, but it's a tremendous advantage to hold it for the longer term. So if you can hold a stock for greater than 1 year, you can make 10 to 20% automatically. So I hope that makes sense. I hope I did a good job in describing that. I tried to go through this very, very simply, describing essentially what a capital gain is, and then why it's important to hold your stocks for greater than 1 year between the buy and sell point. I've referenced this in my Ford videos where I used to do a lot of day and swing trading with Ford, but I've kind of shied away from doing that because I want to save those stocks and essentially keep them for greater than 1 year before selling them off. If I do that, I can make an automatic, again, 10 to 20% depending on which tax bracket I fall in on any particular tax year. So that's the advantage of capital gains tax rates. That's why a lot of investors are buy and hold investors versus day and swing traders. And again, a capital gain can be offset by capital losses. And a lot of investors actually take advantage of this at the end of the year. They'll purposely sell off a stock at a loss to offset those capital gains and then take essentially that capital and put it into another type of stock to essentially shift capital, but also reduce their tax burden at the end of the year. It gets quite complicated in how that's done. There's a lot of different rules that apply to that. You can't simply sell off a stock at a loss and then immediately buy it back the next day, January 1st, or whatever the next trading day is after the new year. There's a lot of different rules that apply to that. Wash sales comes to mind, but there are a number of different rules. So it gets very, very complicated. If you guys are interested, I can go into some of the more sophisticated tax strategies that are utilized at the end of the year. But this is the very, very simple tax strategy. A lot of investors use this tax strategy here, simply selling off a stock after 1 year, or at least 1 year. So you buy a stock, you hold it for greater than 1 year, and you can make an automatic 10 to 20% return on money. So I don't want to talk about that too much here. Just wanted to quickly do a video here explaining what a capital gain is, as well as why it's important for taxes at the end of the year. So if you guys have any questions about that, please let me know in the comment threads down below. I do my best to get back to comments as quickly as possible, definitely within a week, but I try to get back within a couple days. Do my best to get back to you as quickly as I can. So yeah, kind of with this, I'll end the video, and we'll see you guys next time.